Well, hello, Mavericks. Nice to see you. This is Robb Reinhold, and I hope that you are ready to geek out with me on delta hedging. I know it sounds actually. If you would have told me this 25 years ago, delta hedging, I would be like, you talking about the airline? What are we talking about here? Anyway, delta hedging, one of the cool little advanced strategies that we can use as options traders. It's actually a really cool thing, and it's such a better way to do it than stock. And look, I'm not here to bag on stock traders. I started out as a stock trader, and I think that's pretty much where everyone starts out, which is fine. That's just fine. That's where you cut your teeth and you learn some of the business, but you learn pretty quickly in stock trading that stops really suck sometimes. Now, look, you have to have them. You have to have protection. But you find out you get stopped out, and then exactly what you thought was going to happen ends up happening, and you would have made money. And I always say that's the worst trade in the world. Losing money when you're right. That's the worst trade in the world. You were right. You nailed it. But just one day, the Fed governor came out, said something, a one-day plunge in the market, stops you out. 2 days later, it's back up to where it was. A week later, you would have been profitable. So I think we all have probably experienced that as I go through that whole thing. And that's what the market does. The market does it pretty good at knocking people's stops out. So delta hedging is just an advanced strategy as a way to basically put the brakes on your trades. So let's jump into it. It's really one of the coolest things that I learned trading. And I thought this is a really cool thing. And in some strategies, it produces a really positive risk graph. So let's first talk about what is the purpose of delta hedging. All right. The best way for me to describe it is delta hedging is a way to put the brakes on any trade you have. So at any trade, at any time you have, and you say, hey, you know what? I no longer want to and again, I'm going to use a dumb term, but I no longer want to see my P&L change. Now, look, that could be for something good, like, oh my gosh, I'm up on this trade, and I think it might come back, but I don't really know if I want to exit or not. So again, this is where when you have a predetermined exit, you exit. But this is during the trade when you say, hey, you know what, I don't want to exit here, but I definitely want to put the brakes on. And some of the scenarios that I think delta hedging is very good for is unexpected market action. So let me just give you a scenario. Let's say we're in a bull market. Stock market's coming up. We have a nice uptrend. Everything's going good. And then all of a sudden, some news comes out that, well, I was going to say something pretty grim. And yeah, let me think of a different thing I was going to think of. Okay, let's say some natural disaster hits and the market kind of freaks out. But you think this freak out is going to be temporary. But you have a lot of bullish trades that you like, that you want to hold on to. But you can foresee there being a negative reaction short term in the market. Well, your only choices without delta hedging is either get out or stay in and hope it recovers within your time frame of your trade. Now you have delta hedging. And we're going to go through that in a second. So unexpected market action happens. You know what? Let me put the brakes on my trades. Let me just sit it out for a bit, and I'll figure out what to do in the future. Also, upcoming earnings or news. Now, this is one that I use quite a bit. If I have a position, and I really like the position, but it's coming into an earnings report, and I say to myself, ugh, like I've got a nice profit on the trade. I would love to be able to hold it during earnings, but there's too much risk going into earnings. So delta hedge is a great way to basically freeze the trade. And again, we're going to talk about you can freeze all of the trade. You can freeze half of the trade. You can freeze a quarter of the trade. Again, there's lots of cool things you can do with this. But basically, hey, there's news coming up. I think there's going to be a short-term reaction in the price. I want to sit that out. But then I want to be able to stay in the position for the longer term. So that's the way I want you to think about delta hedging. I have a position. I still like it. Something happened or something is going to happen. I don't want to participate in price movement during that period of time. And then I want to be able to maintain my original position after that. That's exactly how I want you to think of delta hedging. Now, the way we're going to talk about it only freezes price movement. So what that means is you're going to have to look at all your other Greeks, and your Greeks are still going to be working for or against you. So just because you froze the price movement, guess what? Your P&L is still going to change based on your other Greeks. So we'll talk about that. The great thing is it can be taken off at any time. So let's really talk about what exactly is delta, how delta works. I don't want to get into this because we have several other sessions on delta. But delta is basically the rate of change of your option compared to the underlying stock. So again, if you have a delta of 60, and again, I'm going to write it in the right manner of delta. So let's say you have a delta, you have an option with a delta of 0.60. This is basically saying for every $1 move in the underlying stock, that option is going to change by 60 cents. So again, if the stock goes up $1, your option should go up 60 cents. If the stock goes down $1, that's right, you're going to lose 60 cents. Now remember, this is delta. We have gamma that says for every dollar the stock moves, gamma is going to change. So let's say gamma is 0.05. What it's saying is basically the first dollar is going to be 60 cents. However, the second dollar is going to be delta plus 1 gamma, which is going to be 65 cents. So what this means is the first dollar is going to be around 60 delta. The second dollar is going to be around 65 deltas. So if the stock moves up $2, you would assume that your option would move up by $1.25. So this is the delta curve on an option. You can see at the money is going to be right at 50. At the money is always going to be 50 delta. And you can see that the further your option gets in the money, the closer it gets to 100. The highest an option can have is a delta of 1. That means for every dollar the stock moves, the option moves $1. And you can see the worst it can get is a delta of 0, meaning that for every dollar the stock loses, you don't lose any more money. It's already gone. It's at 0. So some point there will be no more loss here. So again, this is delta. This is the delta curve. And what we need to understand is, again, delta is not a linear line. It's not a guarantee. When you get into an option, let's say the delta is 50, that delta is going to change. It's going to change as the underlying changes. And it's going to change by the gamma. The gamma is the number that changes the delta. So for every dollar that it moves, that gamma is going to kick in, and you can see that your delta is either going to be getting closer to 1 or getting closer to 0 based on how in the money or how out of the money it is. That's a concept I need everyone to be able to understand as we get into delta hedging, because again, your delta is when you enter the trade, that's your delta, but that delta will change. So we'll talk about that when we get into some of the delta hedging strategies. All right, well, let's first off just do a quick little refresher. Every option has a delta. So again, we go to, this is the Apple calls and puts. We go to 200. All right, it tells you this is the delta. That's the delta. We want to know what the 210s are. Guess what? That's the delta. So this is where you go get your deltas. Sometimes you have to add the delta column. If you don't see the delta column, you have to add it in your software. Say, hey, you know what? I want to see what the delta column is. So all of you should already know where to go find your deltas. We covered that in other sessions. So let's talk about calculating delta. All right, so let's take this example on Apple. We have a $200 call. Question is, what's the delta? Here's the delta at that moment. It is 62. Now again, that's going to be per contract. Now we have 5 contracts. So if each contract is 62 delta points, we need to times 62 by 5. That tells us that this position has 310 long delta points. Again, long calls, we're in a positive delta. So at this point we say, okay, we have 310 delta points. That means for every dollar the stock goes up, we're going to make 310 bucks. That's basically what it's saying. So if you want to completely eliminate the price movement of this position, you basically need to get your delta to zero. We need to get to zero delta. Delta hedging, meaning whatever delta you have, if you have negative 700 delta, you need to create positive 700 delta points. We need to get to a delta of zero. That is the concept of delta hedging. That you have zero delta, meaning if the stock moves up a buck, what happens? Zero. If the stock moves down a buck, what happens? Zero. That's exactly what we're talking about here. The concept is we have zero delta exposure. All right, so again, you will go and find your delta, times it by the amount of contracts you have, and that gives you your total delta points. Now let's talk about creating delta points. Technically, you can use anything to create negative delta. And I don't want to get too far into this, but we have a session on index hedging. Index hedging is a concept of, hey, let's say you have a big portfolio of technology stocks. Let's say that you're a tech person, you love technology, and you've been buying and holding technology for years and years and years. And all of a sudden, technology doesn't look so good. Now, you could go in and hedge out all your positions one by one, but let's say you have a large portfolio. Well, then what you can do is you can go and create basically a delta by selling the same amount of exposure you have against the NASDAQ. And you could do that through the futures. You could do that through the Qs. You could do that through the index. Again, there's a lot of ways to create delta points. Again, you could even, create another options combo. You can create an options combo where if you have a bull call spread, maybe you do put on a bear call spread and cancel out that delta. Now let's keep it simple because this is called delta hedging. And understand that if you use other options to create negative delta, you're also going to make changes to your other Greeks. So I'm going to go ahead and really push you to not use other options to hedge out your options trade because it gets pretty complicated. If you say, hey, I've got this bull call spread, but now I want to throw a long put in it, okay, you can create a zero delta by doing that. But the problem is now you've changed all the other Greeks. You may have more theta exposure than you want. You may have more vega exposure than you want. And all of a sudden it becomes a very complicated trade, and all you wanted to do was just put the brakes on. That's all you wanted to do was just, hey, give me a week to where I don't have to worry about this position. Well, now you've just made it much more complicated. So I'm going to highly, highly recommend that you simply use long short stock. Long short stock is the easiest, simplest, and I use the word purest way to create delta because long short stock doesn't come with any theta. It doesn't come with any implied volatility changes. It doesn't come with any of that other garbage. I shouldn't say garbage. It doesn't come with any of the other Greeks. It's just delta. Again, long short stock is a piece of cake. All long stock has a delta of 1. All short stock has a delta of -1. Period. It has no theta. It has no rho. It has no vega. It's just purely delta. So the purest and easiest and quickest way to create delta is by long short stock. Right, so let's go into a quick example. And again, we'll start at something a little bit more basic. So let's go back to that position. Let's go back to that November 16th, 200 long calls. Those 200 long calls have a delta of 0.62. We have 5 contracts, so we take 5 times 0.62, and it turns out we need to create 310 delta points. So we need to create that. Now, we just talked about there's several ways you could do that. I mean, heck, you could go and do single stock futures on Apple to create 310 delta points. again, it gets complex. Just do the shares. So if this trader had this position on, or if you had this position on, or if I did, I have the long 200 calls, and all of a sudden I say, you know what? I don't want there to be any more delta exposure. Let's say Apple has earnings coming up tomorrow. You know what? I'd like to sit out the earnings, but I would still like to hold my position. I don't want to exit. I still want to hold my position. I just want to sit out earnings. Well, this is what you need to do. You sell short 310 shares. So we just had Apple about a week ago, and Apple did have a 20-point drop. So if you think about it, if Apple had a 20-point drop, this would be quite profitable. That'd be $6,200. And again, we'll show you the delta curve here, or sorry, the risk graph here in a second. But at this point, they've moved their net delta to 0. So for the next $1, in Apple, there really isn't going to be any exposure. Now, after that first dollar, we're going to start seeing gamma kick in. And there is going to start to be some exposure. But again, you're going to see it's not a huge deal. So let's take a look at a risk graph on a long call that has been delta hedged. And what you should always see is and again, I want everyone to focus on the overtime line. The overtime line is going to be the purple line. At expiration, if you just hold this whole position to at expiration, you can see that a delta hedge long call is basically a straddle. It's a straddle. That's what it is. You've got some long delta, you got some short delta, but you can see it's tilted more towards the bear side, and we'll get into that in just a second. But what you should see is around the current price of the stock, you should see this overtime curve basically at 0. And that's what we see here at Apple. We've basically said we're going to put the brakes on, and somewhere between, again, 197 and let's call it 207, you can see there's very little delta exposure. However, after that, there's going to start to be some exposure. And let's talk about really some of the cool things about delta hedging. So here's a great thing. Let's go back to the trade. We had a $200 call, which had a delta of 0.62. And then we sold 62 shares of stock. So let's take the first dollar. And again, I'm going to go ahead and, let's talk about this one later. We'll talk about gamma here in a second. We have 62 positive delta points. We have 62 negative delta points. So on the first dollar that stock moves, we should have 0. However, here's the cool thing. Gamma, and again, I'm going to make gamma, we'll make it an easy number, 0.05. On the next dollar, this gamma is added to our delta. So on the next dollar, our delta on the long side is 0.67. But our short delta doesn't change because it's short stock. That stays steady. So that next dollar, we actually get a 5-cent gain. So you delta hedged a long call position, and the first dollar was flat. The second dollar was the same. The third dollar, guess what? Sorry, the second dollar, third dollar. You're actually, and again, I'm just going to use a static gamma here. I know gamma is going to change as well. But you can see that each consecutive dollar is going to grow. And at some point, let's say this $200 call gets to our highest delta, which is a delta of 1. At some point, every dollar will be worth 38 cents. Again, we're still going to have the negative 62 delta, but once this option gets to 1, we're going to make 38 cents. And that's basically what this risk graph is showing, is that every dollar goes up, you make 38 cents on the position. So as you can see here, you have frozen, okay, what happens right around the current market price, But if it goes up, you make money. Let's take a look and see what happens if it goes down. Again, this is the really cool thing about delta hedging. So again, the first dollar is going to be 0. However, the gamma is now going to be subtracted. So your second dollar, the delta on your long calls is going to go down to 0.57. Here's the thing, is we still have negative 6.2 delta. Oh my goodness, are you telling me that on our second dollar down, we actually made 5 cents? That's exactly what I'm saying. And again, as you can see, each dollar down is going to lose 10. Now here's where it's actually even better. Is at some point, the delta on the short call is going to get to 0. So at some point, every single dollar down is going to be worth 62 cents. So as you can see, on this side, it was worth 38 cents. So we don't have as steep as a line. On the downside, it's worth 62 cents, much steeper. So as you can see here, this position is really similar to a straddle because the risk here is that nothing happens. If nothing happens, you have theta decay. So again, you've got the 200 calls that have theta in it. Every day that theta is deteriorating. However, remember, we don't get any positive theta for the stock. The stock is stock. There's no decay. So this is basically a straddle. We'll make some money if it goes up, make some money if it goes down, and if it doesn't go anywhere, we lose time decay. Really cool. This is a really cool little strategy. So on a long call or a long put, this is a beautiful strategy because if you're wrong, so let's say you went into Apple's earnings, with a long call. And again, the stock was around $222 before earnings. And you can see that today the stock is down around $202. Sorry, not the price, but 202. If you were to do this delta hedge before the earnings and you had a long call position, you can see that the earnings miss was profitable for you. You can also see that if the earnings beat and the stock jumped up to 240, you could see it would still be profitable to you. It's a really cool strategy. To basically, you're taking a little bit of your skin off the table. Now look, if you went into the Apple's earnings with long calls and you did not delta hedge and the stock went to 230, you would make a whole lot more just with the long calls. Understand that this is a hedging strategy. Whenever you hedge, you make less. You're saying, I want protection. My reward automatically goes down whenever you hedge. So this is just a cool little strategy. One of the things I wanted to go through is that on Thinkorswim, if you want to see what adding in long or short stock does, all you have to do is create a line here. You can see here I've got my one option. I got a long November $200 call, and I've got short stock in the right amount of stock. And it's really cool here because the delta here is going to tell you right what to do. Technically, I should have sold short 313 shares since the delta is 312, but you guys get the point. So a really cool strategy. Again, going into a report, you're taking some money off the table, but you're also giving yourself the ability to make it on the downside. So on long calls and long puts, it basically will create a straddle. That's really what you're going to see on long calls and long puts. Let's talk about how to delta hedge out combos. So let's say you have a combo trade on. Let's say you have a bull call spread on. You have the November 200 calls, and you're short the November 205 calls. So again, you're long one, short the other. So you're long plus 62 delta points. You're short 0.43 delta points. As you can see, if you add those together, you're going to get your net delta. So your net delta on the position is 0.19. So you times that by the amount of contracts, and it's telling you, okay, if you have a bull call spread and you want to put the brakes on. You want to put the brakes on to where for the next dollar there's no adverse results. You're going to sell 96 delta points. That's going to take your delta to 0. All right. Now here I'm going to show you a risk graph on what a delta hedge looks like on a bull call spread. And you can see, boy, that is a strange looking risk graph. I always have called it the lightning bolt. Ooh, I've created a lightning bolt. Look at that. Now again, the blue line is at expiration. At expiration. But really what we're looking at is we're looking at the purple line over time. There is no reason to delta hedge until expiration, because if that was a point, you should have just got out. So again, I want to get hedged temporarily, and then I want to take the hedge off. We're going to talk about taking the hedge off here at the end. But as you can see here, it's basically completely flattened out our line. So from $196 all the way up to basically $209. We have flattened out our risk here to basically 0. Again, we have 0.19 of net delta. We created negative 0.19 delta. And the gamma on this, remember, we're going to have positive gamma. Let's say we have positive gamma of 0.05 on our long call, but we're going to have short gamma of 0.03. So our exposure of gamma is only going to be like 0.01 or 0.02 on most of your spreads you do. So this is going to move very slowly. So as you can see, we're starting off with a lower delta. So the next dollar move up, okay, we're going to have again 0.02 delta. You can see the next dollar is only going to be 2 cents. And then the next dollar after that might be 3 cents. It's going to move very, very slowly on a bull call spread. Now, outside of that, you can see we start to get some risk if there's a big movement. So this is where I'm not a big fan of delta hedging, like vertical spreads going into like an earnings report. The reason is that I'm basically making it to where I don't make any money unless there's a huge move. And then, you know what? The bear call spread probably looks something like this. Like, you're going to have less risk with the bear call spread. You're going to have much less risk with the bear call spread because in the end, the delta is going to get to, again, a certain level. And then you don't make any more money after that. So, well, technically speaking, once both of these options get 100% in the money, both of the deltas are going to be 1, so you get 0. You get 0 delta if it goes up a lot. And at some point, when it goes down a lot, you get 0 delta as well on a vertical spread. Again, they're both out of the money. They both have 0 deltas. But what you have is you have the long or short stock working for you or against you. And the reason you get into verticals is that, hey, you know what? I want to be able to cap my losses. I want to be able to know that I have a $500 max loss. In this one here, it'd actually be a $1,000 max loss on this trade, roughly. So as you can see here, all of a sudden we've created a risk graph where we have more than that potential, and we have no way to really quantify our risk here. But look, you could do delta hedge on a bear call spread or a bull call spread. You could do that. I would only do it though if you kind of think it's going to stay around this area and you really just want to put the brakes on for, you know, maybe some market gyrations that are causing some anxiety or issues. And again, we're going to talk about when to put on the delta hedges, but I just want to make sure everyone understands really what's happening when you do delta hedging. All right, here is a delta hedge on a diagonal call spread. And I want everyone to focus in the certain range. Again, we have really 196 to basically 208 is basically flat. There's going to be really no adverse effects. But you can see we all of a sudden outside of these ranges have some pretty adverse effects. Now look, it does improve the bottom of the diagonal. So if we looked at the true diagonal spread on this, it probably looks more like this. So you can see is here we've moved up we're worst case scenario, but we've moved down the best case scenario. So going into an earnings report or going into a report where you think there's going to be a big move, you can see this isn't the right strategy because it's going to have a loss on both. If there's a big move up, you're going to lose. If it's a big move down, you're going to lose. Again, I'm not a big fan on delta hedging diagonal spreads. But, you can do it. You can do it. Now, look, I do have some traders, and I actually do like this strategy, that on their diagonal call spreads, instead of exiting at a certain point down here, they put in a delta hedge. And the reason I do like that is because if you've done any amount of trading with options, if you try to put in a stop on a combo, you're going to have to use a stop market order, and those market orders can be filled at wild prices. And a delta hedge here is a way to basically make sure you get filled at a very good price. Again, getting filled on stock, very easy, very tight spreads. It's one trade, and it basically freezes it to where then you can work out of the trade manually if you want later. So again, I do like that strategy. If you are the one person who likes to put stops in on your diagonal call spreads, but you found out that, oh crap, I get a lot of slippage, I get a lot of bad fills, then a delta hedge at that point, I think it's a very great idea. So again, if let's say on Apple, you say at $192, I want to keep my loss to $1,000. Well, the only way to do that on a diagonal call spread that has a longer leg than that is to put in a stop saying get me out. However, like you've seen, you get messy fills. A delta hedge, now again, you'll have to calculate what the delta is going to be at 192. But at that point, you just to put in a sell order. I need to put in a sell stop order for the stock at 192 for, again, 17 shares per contract, whatever it is. Well, I wasn't going to cover that, but I'm glad we did. That is, again, it's a little cool strategy. It basically it's a stop for diagonals without the crappy fills. So, all right, and then I thought, let's get crazy here. Let's look at a hedged butterfly. Now, this is kind of silly to hedge a butterfly because if you enter an at the money butterfly. So again, if the stock is at 205 and you entered a 200, 205, 210 butterfly, your delta will be 0. So to delta hedge a 0 delta position, it's a little silly. All right, so that being said, we have some traders that do what we call directional butterflies. Directional butterflies where they say, hey, you know what? I think the stock's going to go up to 210. The stock right now is at 202. So they open up a butterfly up above the current market price, and that all of a sudden is a positive delta trade. So at any time you want to go to 0 delta, you know what to do. Find your net delta, sell it, and you can see all it does is it flattens out the overtime line. Now it does create some pretty wild at expiration risk graphs. It always makes me laugh. And I used to, when I was a younger trader and got options pricing software, I used to play around to see how crazy of a risk graph could I make. How many break-even points could I have? This stock or this position has 3 break-even points. Again, it's a silly trade to even put on for at expiration. But the whole point is putting the brakes on and waiting for things to change to where it's more conducive to your hedge. So let's talk about when to remove the hedge. All right. Now, let me first off talk about this last one. One adjustment per trade. Okay. Now, when people see this strategy, or they learn about adjustment strategies on like condors and butterflies, I have some people that think, oh my gosh, are you telling me I never have to take a loss again? I can just delta hedge and then wait for it to come back? Theoretically, and again, this is purely theoretically, the answer to that is yes. So if you have a stock going against you, let's say you have a long call, you delta hedge it, theoretically, if you're able to hold on to it for long enough, you could make money regardless of what happens. Especially if you delta hedged at the right time, the stock plummets, you get out of your short stock, and then the stock recovers, you could theoretically make money on both sides of the trade. So again, let's go back to the first trade. With the $200 calls, you delta hedge, it crashes down to 190, you get out of your delta hedge, it runs all the way back up to 220, you still have the long calls. You can see you can make money on both sides, technically. But let me caution you, because whenever people read and find out these strategies, a lot of them use it to delay taking a loss. And they say, I don't want to take a loss on this. I think I'm right. And what they do is they say, okay, I'm just not going to admit I'm wrong now. I'm going to delta hedge it. And then what happens is, at some point, they say, okay, and then I'm going to figure out when to remove the delta hedge. And then they think it's bouncing. So you know what they do? They take the delta hedge off. But then guess what? That bounce doesn't hold. And it goes right back down. So do you know what they do? They put another delta hedge. And then it starts to run again. They say, you know what? Let me take off that delta hedge. And then it falls, and they say, oh, crap. Let me put that delta hedge back on. Does everyone see what just happened there? This stock basically went sideways. And this person just created 2 or 3 losses from them off delta hedging, when they should have just stayed with their original position. So please don't use this ever when you're in a situation and your trade has gone against you and you don't want to take a loss, and you say, you know what, all I need to do is delta hedge. Because what that's doing is you're reacting to market action. And as I've said many times, hopefully you've heard this, the market is really, really good at pushing people to making the wrong decisions at the wrong time. That's what the market is so good at. It's at the creating panic, creating greed. It's really good at it. And if you're going to go off your gut feelings, or you're going to say, I'll figure it out, or I'll make a decision later, I'm telling you what, your emotions are going to be pushing your decisions. So first off, have this predetermined. I just gave you an example of a predetermined delta hedge on a diagonal call spread. Okay, if it goes down to this point, I'm going to delta hedge it out. Okay, great. That is predetermined. That had nothing to do with market action. That had nothing to do with your feelings. That was predetermined. Okay, if I do this strategy, if it goes below support, I'm going to delta hedge. So again, let's go back to the Apple $200 long calls. Let's say that there's major support at let's say there's major support at 200. And all of a sudden, hey, you know what? I'm going to make a decision that if it goes below 200, I'm going to delta hedge. Okay, great. That is predetermined. So make sure that the entry is predetermined, but also make sure the exit is predetermined. So my rule is remove the hedge when the reason you hedged is gone. All right. So again, if everything's predetermined, then we can easily find out when that rule is gone. So let's say that we wanted to delta hedge because we were worried about the gap on Apple after earnings. Okay, guess what? We know when to remove the hedge, when that is gone. So Apple gap down 20 points. Okay, well, we wanted to avoid that. We just avoided that by delta hedging the day before. That reason is now gone. We should take off the delta hedge or close the entire position because we no longer like the position anymore. If the earnings were better than expected, again, either exit the whole position because you no longer like the trade, or you remove the hedge and hold the original trade. So if you predetermine, removing the hedge is a no-brainer. Hey, if I predetermined that I'm going to delta hedge when Apple breaks 200, then guess what? Shouldn't I determine that I take the hedge off when Apple goes back above 200? That would make sense. That's very logical. That was major support. If it breaks below it, if it breaks back up above it, saying that, okay, it's now broken out of resistance and should go higher. So for me, removing the hedge when the reason you hedge is gone. Let's take some other situations. Let's take elections. Okay. Let's say there's major elections coming up. And let's say the elections are today and you're worried about the results of the election. So the reason you hedged was because of volatility created by the election. So let's say the election was later today. You delta hedge in the morning. You're going to get election results overnight. You're going to get a big move, likely tomorrow, maybe a little bit more the next day. You predetermine, I'm going to wait 2 days and then take my delta hedges off. There you go. You just quantified it. You predetermined when it was going to be. Now let me throw in this last thing, one adjustment per trade. This is my rule. And I made this rule for me because I've tried to be that idiot that says, oh, let me just delta hedge around the trade. When I think it's going down, let me put a delta hedge on. And then when I think it's bottomed out, let me take the delta hedge off. And then if it runs and fails, I'll put a delta hedge on again. Look, if you're going to do that, just go day trade. Don't you see that's all that is? All that is short-term trading delta. And if you're going to do that, just go do that. Just go buy and sell the stock. Just go buy and sell the long call. I mean, make your life easier. Don't have this underlying position that you're like day trading around. It's silly. One adjustment per trade. That's my rule. I get one shot. If it's going against me, I can delta hedge. Once I take that delta hedge off, my only choice after that is to exit the position if it goes against me again. Period. I cannot delta hedge twice. That's my rule, and I've made that rule because I've tried it before, and I got into this emotional delta hedge, take it off, delta hedge, take it off. Found out that I created a larger loss than my max loss was for the position. Not very smart. So the rule is one adjustment per trade. All right, let's get into one last cool thing. And I actually talked with Corey in the office about this, and this happened recently. Taking profits after hours. So one of the negatives about options trading is that when you get a big move in your favor, and it happens after hours, a lot of times on earnings, there's no way to take profits. And you literally have to wait till the next morning until the options markets open up in order to take profits. But there can be situations where you want to take your profits then. I remember we had a Netflix call ratio back spread that the stock jumped up to 395 after earnings. So it wasn't like 340. We did a call ratio back spread, and I saw this thing at 395. And I remember thinking, boy, I would really like to get out now. I would really like to get out now. But I can't sell the options. I can't actually get out. And I actually thought, you know what, I could delta hedge this. So basically, I would go in and calculate my net delta when the stock's at 395, and I could have gone out and sold short the right amount of delta points at 395 after hours. Now, what that would do is that would basically lock in my gain until the next morning I could actually get out. Now, what happened is the stock actually dropped, and when the market opened, the stock opened up at 385. So if I did this, I technically would have made 10 points on my shorts, on my delta hedge, and theoretically I would have, I would have made 10 points here, but I would have lost 10 points on my long calls. I theoretically would have been out at 395. So this is just a really cool little strategy, delta hedging after hours to take your profits. Now this is much more clean on long calls and puts. This gets messy on vertical spreads and any other spreads. This gets messy. I would only say that if you have long call positions or long put positions, this will work. Because remember, it turns into basically a straddle. And again, and your straddle is probably going to be above the break-even line anyway because you're in so much of a profit. So again, this is a simple way. I shouldn't say simple. This is a way that you can actually take profits after hours on long calls and long puts. Like I said, I wouldn't really advise to use it on any sort of spreads. It gets messy because remember the risk graph on spreads, if you get it wrong, remember one of the legs goes against you. So if we go back to our risk graphs, if you're in a vertical spread and you exit, but then it wildly changes overnight, you could be looking at this. You could have taken a profitable trade, a bull call spread, and you could have turned it into a loss. That's dumb. That's really, really dumb. So again, I really only like that strategy on just straight long calls and puts after hours. All right, again, to me that's a really cool little way. If you've got a long call put, you get the big pop after hours, you say, hey, you know what? I want to take my profits here. Delta hedge that out. Delta hedge it out, and you've basically locked in that game. All right, so let's wrap up delta hedging. And hopefully, I've really stimulated your brain here, but it's a pretty simple concept. You want to calculate your net deltas, and you want to make the delta 0. Now, of course, on every strategy, once you get further and further away from where the stock is at the moment, your deltas are going to start affecting you more. And we looked at those on risk graphs. So if there are wild big moves, there still is going to be some delta exposure, but you at least froze it to close to at the money. Everything needs to be predetermined. This is a strategy that when I teach people and show people this, sometimes I see them using it just spur the moment. Oh my gosh, I'm freaking out. I'm going to delta hedge. And again, like I said, the market is really good at pushing you into making the wrong decision in trading. So predetermine it. Put this in your trading plan. Put this in certain strategies and use it. It's awesome. And again, the removing of the hedge is just as important. I like to use charts of when to remove it. Hey, you know what? I got out of this because it broke the 50-day moving average. Why don't I remove the hedge? I delta hedge when it broke the 50-day. Why don't I remove the hedge when it gets back above the 50-day? Again, all that stuff can be quantified and predetermined. All right. Thank you so much for joining, everyone. That was delta hedging. See you later. Goodbye.